All right, we will get started now. Thank you for attending our webinar on tax management strategies. My name is Nathan Krampe. I am a certified financial planner and vice president here at Summit Investment Advisors. Now, before we get started, I want to highlight a couple of the areas of expertise that we focus on here at Summit. You can go to our website, summitinvest.com, and you can pull up those areas of expertise. As I pull it up here, the first things you'll notice when you go to our website is our approach, some of the services we offer, and then we also have some of our insights. And that includes previous webinars and workshops that we've done, as well as some of the white papers and our blog as well. Now, the other area that I wanted to focus on is that we do have what's called our second opinion service. And what that is a way to offer to friends, coworkers, close relatives, just a second opinion on their finances. So that's a little bit of everything you can find at our website. Now, the three areas of expertise that we focus on here at Summit is financial planning, investment management, and then estate planning. We're going to focus on the piece of the puzzle that comes with the financial planning side of it, and specifically tax management or tax mitigation. Those are some of the things that we can really dive into details today and work with kind of taxes for the coming year. Now, outside of financial planning, we also focus on the investment management, which is saying once we have a plan in place, how do we use investments to meet our goals or to help meet our goals? And then lastly, the estate planning is all about wealth transfer. So with that, I would actually like to introduce our speaker for this afternoon, Sean McDermott. Sean is a 27-year veteran in the industry. He is also a certified financial planner and the founder of Summit Investment Advisors. He is Series 7 and 63 licensed, as well as a registered principal. Now, Sean specializes in working with retirees and the health tech and med tech industries with a lot of different executives and professionals in the industry to really dive into details of some of the needs and goals and wishes for the industry in general. Now, outside of that, Sean does focus on retirees and making sure that they have everything they need to not only become retired, but stay retired. So with that, I would like to introduce Sean McDermott. Sean.
Thank you for joining us. Comedian Jimmy Kimmel said, "Tax day is the day that ordinary Americans send their money to Washington, D.C., and wealthy Americans send their money to the Cayman Islands." Today's workshop, we're not necessarily going to talk about sending your money to the Caymans, but we're going to talk about saving enough in taxes to maybe take a nice vacation to the Caymans. In the next 30 minutes or so, we're going to talk about three goals. First, introduce you to how income taxes work. Second, to educate you on tax-favored investing and saving strategies. Thirdly, to illustrate tax planning opportunities. Taxes are a big part of life. The average federal refund check for 2014 was $2,792. Just under 110 million returns qualified for a federal refund for the 2014 tax year. Put another way, the government refunded $306 billion to taxpayers. Now, we don't necessarily think that this is a great strategy to be getting a great big refund check. Instead, we would suggest using your own money to invest into your stocks, bonds, mutual funds, and retirement plans throughout the year instead of getting it back at the end of the year from the IRS. So who pays taxes in our country? The Brookings Institute Tax Policy Center estimated that 43% of all households have no federal tax liability. They also found the wealthiest 20% of taxpayers paid 84% of taxes in our country. So how wealthy do you have to be in the top 20%? Well, to qualify, your household has to have adjusted gross income of about $111,000, which many single and jointly filing couples out there are well above the $111,000 and therefore in the 20% top 20% tax brackets. Now, American households face many different types of taxes. There's federal income tax, there's Social Security tax, Medicare tax. In addition, we have state income tax, we have sales taxes, excise taxes on gasoline, tobacco, and alcohol. We also have taxes on telephones and utilities. You name it, it seems like everything from property taxes to sales tax, it's all being taxed these days. And it ends up being a very large burden on our earnings and our investment income. I love this quote from Dave Barry. He says, "It's tax time. I know this because I'm staring at documents that make no sense to me no matter how many beers I drink." This slide illustrates the average return of stocks between 1926 and 2009 on an after-tax return would have been 7.7% per year. Now, if you're able to defer your money or manage for more tax sensitivity, your rate of return would have been 9.8% a year, or closer to 10%. So that's about 2% better rate of return over time. So remember that government is the highest expense you have when investing. And I hope you all know the difference between tax avoidance and tax evasion. Of course, it's 15 years in federal prison. So today we're going to talk about tax avoidance strategies, not tax evasion strategies. Will Rogers said the difference between death and taxes is that death doesn't get any worse whenever Congress goes into session. As administrations come and go, so do different tax policies. Since 1940, there's been about 80 major changes to our tax policy. And now that we have a new administration in, the Trump administration, he's proposing some dramatic changes to the current tax system, which I'll talk about throughout this presentation. Let's begin with how income taxes work. We start with our adjusted gross income, which can be your wages, pension income, unemployment income, dividends, capital gains, IRA income, Social Security benefits. So basically any income that you have coming in from sources throughout the year. From there, we make some adjustments such as IRA contributions, simple IRA contributions, maybe health savings account contributions, and deductions for student loans. We arrive to our adjusted gross income, which is typically on the bottom page of the first page of your tax return. And then we go to our second page of the tax return and we subtract our deductions, which could be a standard deduction or an itemized deduction. Itemized deductions are typically going to be things like mortgage interest expense, health expenses throughout the year, property taxes, and so forth. And if you don't have enough in itemized deductions, you'll be taking a standard deduction. After that, there may be personal exemptions depending on the number that you're claiming for your family and your age. If you're over 65, you get an increase to your exemption amount. And I'll go through the amounts that you have for exemptions and deductions in some later slides. This is how you arrive at your taxable income. From there, you might be able to subtract out some tax credits. That could be possibly for maybe energy tax credits, which there was a few things for like windows and insulating your homes or converting to geothermal heat. There also might be education tax credits as an example. From there, you say, okay, well, we've already paid in this amount in taxes. And so what you arrive at is your tax bill due, or maybe you're getting a refund that year. Now, for those on Social Security benefits, I want to point out on this federal income tax return, as I mentioned, you'll see in that first section there, lines 7 through 22, you have your wages, the dividends, business income, capital gains, IRA distributions, pensions, annuities, etc. I'd like you to pay attention for those on Social Security benefits to line 20A and 20B. And here's where you can play with the numbers a little bit to possibly reduce the taxability of these benefits. And so your tax rate, the higher your income, the more your Social Security is going to be taxed. In addition, the tax rate for your dividends and capital gains can either be 0%, 15%, or 20%, which I'll expand on a little bit later. Now, moving on here to the second page of our return, a couple of things that we want to pay attention to would be line number 43, where it has your taxable income. And the taxable income, when we go to our tax brackets, we're either going to fall into one of three general brackets. And one of the things that we want to pick up from the tax return is to make sure that you're not in a negative tax bracket. And what this would mean is that you have more deductions and exemptions than you do have coming in income. Whenever we see that happening for clients, for example, I had a recent client that we're doing tax planning for who had $15,000 of pension income coming in, but was not drawing their Social Security benefits and was not taking any income from IRAs or retirement plans at this time. What we looked at is that with their standard deduction and personal exemptions, they had about $20,000 of write-offs and only $15,000 of income coming in. So therefore, they're in a negative $5,000 or a negative tax bracket by $5,000, which in this case we suggested doing a Roth conversion for $5,000 to $10,000 this tax year, so they would not have to pay any income tax on that retirement plan, any federal income tax, I should say, on that retirement plan, could put it into a Roth IRA, and once it's in the Roth IRA, it's tax-free growth and compounding indefinitely. So there are some different tax strategies and things that you want to look at throughout the year, and you want to be making these tax moves during the year, not when you're doing your tax return, because when you're doing your tax return, a lot of times it's too late to go back and do Roth conversions and realize capital gains from the prior tax year. So do tax planning well in advance of doing your tax return. Let's take a look at the marginal tax brackets for 2016. As you'll see here, for a single taxpayer in the yellow, if your taxable income is below $9,275, basically you're in a 10% tax bracket. Once you're above the $9,275, you're in a 15% bracket. And then once you hit the $37,650 level, you're in a 25% bracket. You can see the brackets kind of gradually go up from there. In the red, you'll see the married filing jointly. So anything taxable income between 0 and $18,550 is at a 10% tax rate. And then anything over $18,550 but below $75,300 is in a 15% rate. And then above the $75,000, the brackets go up from there. 2017, the brackets do adjust slightly. And what we want to know from these marginal tax brackets is really important, because if you're in a 10 or 15% bracket, your capital gains and qualified dividends could very well be at a 0% tax rate. So, for example, I was recently working with a client, and they had roughly $70,000 of income coming in, and after deductions and exemptions, it brought them down to $50,000 of taxable income. So what we calculated is that they could take about a $25,000 long-term capital gain, and it would qualify for a 0% tax rate. And so, again, we want to know what your bracket is and where your marginal tax rates are, so we can do some other advanced planning with your investments. Now, the Trump plan, which is we're learning a little bit more about, and we don't see that much happening right now in Congress, but I assume throughout 2017 they're going to be working on the new tax law reform or the new tax package. But what we're seeing is that the plan would eliminate the 10 and 15% bracket, instead just combine it so there's a 12% bracket. And then the next bracket up would be 25% for taxpayers between $37,000 and $113,000. That's single taxpayers. And if you're joint, it'd be $75,000 of taxable income to $225,000 of taxable income would be at a flat 25% bracket. And then above those amounts, you'd be at a 33% rate. And so basically, they're trying to simplify it a little bit by having a less number of tax brackets. Now, there's a chart here we're looking at. These are the annual limits related to financial planning. So this chart you're able to download from our website, or else just shoot us an email and we'll get this off to you. But it shows how much you can contribute to 403Bs, 401Ks. Basically for 2017, it's $18,000 pre-tax. And if you're over age 50, you could do an additional $6,000. So a total of $24,000 pre-tax into many different types of employer-sponsored retirement plans. And oftentimes we're seeing throughout the year that clients are forgetting to adjust these amounts up to the higher pre-tax amounts. And so be sure to look at that. Be sure you're putting away what you can on a pre-tax basis, because it makes a big difference over time. You can also see the Social Security wage base has gone up to $127,200 for taxable amount of Social Security. And other than that, not a lot of other major changes. The only other one I'd comment on is that your Medicare monthly premiums can be substantially higher if you had a higher income from a few years back. And we've experienced clients that have had high income in one year and their Medicare premiums have skyrocketed to $500 or $400 per month per person because of a year that they had more gains or stock sales. And so what we'd suggest there is that if it was a kind of an anomaly and it's not something that you're expecting on a year-by-year basis, that you can actually go to the Social Security office and talk with them to get these Medicare premiums reduced. Otherwise, you have to wait for the tax return from 2 years prior to get to Medicare before they'll reduce your premium amounts. Now, one other quick note, Trump has proposed dramatic increases in the standard deduction, which around 70% of taxpayers use the standard deduction instead of itemizing. The amount would increase from $6,350 for single filers to $15,000. So that's a huge increase. And for married filing jointly, the standard deduction right now is $12,700. It would jump all the way to $30,000. And that's pretty huge. So the only other thing on this side of talking about itemized deductions is that itemized deductions would be capped to $100,000 for single payers and capped at $200,000 of deductions for married filing jointly. There is a phase out of your personal exemptions, as you'll see from this chart. So if you're in the higher brackets, you might not be able to take the full personal exemption. And then if you're itemizing your deductions, there's phase out numbers also for higher income taxpayers. Now this is an important chart to know about, and it relates to capital gains and dividends. What we're looking at here is if you're in a lower tax bracket, a 10 or 15% bracket, then your capital gain tax and dividend tax rate is 0% on the federal side. So once you're over or into the 25% rate, then your capital gain tax rate is at 15%. And if you get up into the 39.6% tax bracket, which is the highest tax bracket for married filing jointly, it's over $400,000, then you're going to be paying 20% capital gain tax rate. So we're finding that a lot of clients are able to find themselves in a 10 or 15% bracket when they retire and receive qualified dividends of capital gains at a 0% tax rate. This is a significant tax savings that you want to be aware of, and especially for people that have stocks that have appreciated in their retirement plans, or they've been doing employee stock purchase plan purchases. We want to take a look at it and try to find areas that you can take capital gain income instead of ordinary income because of this tax reduction of anything from 15% to, or 10 to 15%. Okay, big tax savings here. Kind of, you need to know your different tax brackets in order to implement them. Okay, now this gets into taxes on Social Security benefits. So once again, it's a really good idea to go back to those tax returns, line 22A and 22B, to see if your Social Security is being taxed. And this is going to be determined by your provisional income, which you can kind of see the thresholds in the slide right here. And so it just means more tax on your money if you're not being careful with how you're drawing the income from your retirement plans. And again, we highly recommend some advanced planning to reduce Social Security income tax, or Social Security taxation. So what does your tax return say about you? Well, we always, like I say, want to look at your Form 1040A along with your Schedule B, which is identifies which investments you're paying tax on a year-by-year basis. As I mentioned in an earlier slide, you could be reducing your returns by 2% per year if you're not deferring your money, or if you're in the wrong types of investments that keep spitting out capital gains and dividends on a yearly basis when you're in a higher bracket. So again, we want to know in advance before you do your taxes and do some pre-planning throughout the year to get these tax rates down. Love this quote from Jay Leno. Worried about an IRS audit? Avoid what's called a red flag. That's something the IRS will always look for. For example, say you have some money left in your bank account after paying taxes. That's a red flag. So let's talk about some tax-favored investing and saving strategies. Tax-favored investing, there's a couple different types. We have tax-exempt investments and tax-deferred investments. Tax-exempt investments would be your municipal bonds, money market funds. Tax-deferred investments would be things like your qualified retirement plans, IRAs, 401ks, employer-sponsored plans, annuities, and life insurance. Now, the municipal bond market represents about $2.4 trillion that municipalities have borrowed from different resources in order to fund projects. So that amounts to 8,468 for every man, woman, and child in the United States. Now, the municipal bonds, the advantage of them is that when you collect the interest from a muni bond, it comes to you on a tax-free basis. You don't owe any federal income tax, and typically you don't owe any state income tax as long as the bond is held here or held in the state that you're a resident in. So if you're a Minnesota resident and you own Minnesota municipal bonds, there should not be any state or federal income tax. And again, you could do the bonds individually, or you could do them in a bond mutual fund. There's a chart here that just shows the tax equivalent yield on bonds and the advantages. And then, of course, we roll into your tax qualified retirement plans. And these are the plans that you generally will see through your employer, the 401k, 403b, or if you're not working for a company, you could be doing a traditional IRA and deducting on your taxes, or maybe doing a Roth IRA. And again, the contribution amounts are $5,500 if you're under age 50 and $6,500 if you're over age 50 on an IRA. Now, why is it so important to invest on a pre-tax basis? As you'll see from the chart here, that if you're investing $1,000 into a pre-tax plan, the full $1,000 is getting invested for you. If you're investing into an after-tax plan, basically you have to earn $1,389 in order just to invest $1,000. So it takes another $389 that's being sent to the government every year. And so without a doubt, the best way to grow your money for retirement is going to be in a pre-tax, tax-deferred retirement plan. However, for some people that have longer time frames and are in a lower tax bracket, we might suggest using after-tax investments like a Roth 401k or a traditional 401k plan. Now, the tax-deferred plans, again, there are many people already using them. You're familiar with how they work and what they do. One of the other considerations that we want to look at on a year-by-year basis is if you're eligible for a non-deductible a non-deductible IRA contribution. So even if you do have an employer plan available, like your 401k or 403b, you still might be able to be doing non-deductible IRAs. And let's say you're over age 50 and you could put away $6,500 into a non-deductible IRA. Well, if you put it away into non-deductible, what you could do is convert it to a Roth IRA within the same year, or within 3 to 6 months after that. Convert it to a Roth IRA. There's basically minimal taxes due because you already paid tax on the original investment. You just have a little bit of tax if there's some gain. But then once it's in the Roth IRA, it is tax-free growth indefinitely. So the original investment you can always get back, but the growth without any tax penalty and without any restrictions, but the growth on it, as long as it's left there for a period of 5 years, it's tax-free growth. And so for sure, ask your financial planner or ask us about non-deductible IRAs and later on doing a Roth conversion. Chart here that just looks at tax-deferred growth and how much more it adds up to over time. And let's move on here and talk about some of the tax planning opportunities. So first one here would be tax-free exchanges. There's stock and bond swaps and 1035 exchanges. So a stock and bond swap would be as if you have highly appreciated stock in a company, you could take that stock and put it into an exchange pool, diversify it between many other types of stocks out there, and you would not have to pay a capital gain on it. So this is a strategy that high net worth individuals use. We don't see it being used too often, but be sure to, again, consult with a professional if you do have highly appreciated stock. Charitable contributions, obviously are another tax strategy. And again, you could be itemizing your charitable contributions on a year-by-year basis. The other thing that we'd suggest looking at with charitable contributions is to have your required minimum distributions. Or if you're over age 70 and a half, you have to start taking money out of your retirement plans. And you could have the required minimum distribution go directly to a charitable organization. And this has its advantages because it doesn't show up on your federal tax return. Because once it gets on your federal tax return and then you deduct it from there, well, first off, you might be just taking a standard deduction, so the charitable contribution isn't helping you anyway. And secondly, when it shows up in your federal return, it is counted as provisional income and could be increasing the taxability of your Social Security. So again, look at having RMDs go directly to charity if you're giving to charity on a yearly basis. There's also other programs you want to look at advantages of donating highly appreciated assets. So we see this where, again, employees of companies that have highly appreciated corporate stock, they could gift the shares to a charitable organization, and some corporations actually have gift matching programs. So be sure to look into matching programs with your company whenever you're giving to charity. Selling a home, a lot of movement in the housing market these days, with especially with baby boomers that are moving to single level living or maintenance free living. Just a couple reminders in this area. If you're married filing jointly, and if you sell your home, you can take up to $500,000 tax-free gain. If you're single, $250,000 comes out tax-free, and you don't have to reinvest it back into another property. So keep this in mind if you have appreciated real estate. What if you get audited? Well, here's the answer to that. Dave Barry, love this quote. And to you taxpayers out there, file your tax return on time. And remember that even though income taxes are a pain in the neck, the folks at the IRS are regular people just like you, except they can destroy your life. So how can you better manage your taxes? First, understand how income taxes work. Second, practice tax-favored investing and saving strategy. And thirdly, utilize tax planning opportunities. We talked about all three of these areas today. Hopefully we've prompted some thoughts and ideas that you might want to consider for your own tax return. And where do you go from here? Well, you can do it yourself. And we do have a lot of people or clients that prep their own tax return. And just for people, for your knowledge, the IRS on their website, if your income is below $66,000, they have a free filing software right at the IRS.gov website. And there's roughly 100 million taxpayers that qualify for this free filing at their website, and only 3 million people actually utilize the service. So that is there for you. Or you could work with an accountant or CPA or tax practice. But if you're serious about tax saving strategies and investing strategies, please do work with us. We have a tax advisor right on staff here, plus we have other associates that are CPA firms that do a really tremendous job at tax planning strategies. And again, hopefully you can save enough in taxes to take a nice vacation to the Cayman Islands. That's the ultimate goal. Here's our contact information. A couple of quick notes. We do have some other workshops coming up in the next following months. We have one called Brainworks in March, and that's going to be a really fun workshop taught by Janus Labs. And then in April, we're going to be having our Declutter Now workshop taught by Home and Garden TV expert. Very popular course, especially for people that are considering downsizing or maybe helping somebody else do some downsizing. So with that, feel free to email or call us with any questions or thoughts. And again, we appreciate your spending time with us this afternoon, and make it a great day. Thank you.